Good morning, everyone. This is Curtis Hawks, Chief Marketing Officer over here at Insurance Agency Marketing Services. And I want to thank everybody for starting their week with us and joining us for this webinar. We've got, I think, some very important content to cover. I think, one of the key things as we see legislative risk, and really what I mean when I say legislative risk is Congress's ability to shape and mold the way in which we pay taxes. I think as we continue to see that, especially going back and looking at the Inflation Reduction Act here a few months ago, the importance, the need for the utilization of tax advantaged assets inside of somebody's portfolio is just more and more paramount. I think we're going to continue to see that as we keep going forward, especially over the next couple of years. And so, got a great topic for you this morning. Before diving into that, did want to take a minute here and talk about some of the additional ways that IAMS is here to help support your business. First up is our new producer builders. And so for those of you that are new to IAMS or maybe aren't currently working with us, this is a great way for us to partner with you in your first 6 months with us. This allows you to, as you're producing business, qualify at different production tiers. And we've got a variety of things on there, whether it's marketing reimbursement, cash, trips, marketing programs. In fact, one of the cornerstones of IAMS is customized marketing. And so if you happen even to be doing something currently that's working well for you and you just want to figure out how can we help partner with you on that, reach out, talk to a sales director over here at IAMS, and we're more than happy to chat with you about that. Phone number here is 800-255-5055. In addition to that, we've got a referred producer program. So for those of you that are currently working with us, if you know an advisor who you think maybe might be a fit for us or isn't maybe happy with their current relationship, send them our way. Not only will you get a $50 bonus when they first get contracted, but then on a quarterly basis, you will get checks based off of the production they're doing. And so it's a great opportunity to be able to increase your revenue. We'll take care of all the service. You don't have to do anything with them. And so great opportunity to diversify that. We see, those are some of the biggest checks we cut out with advisors. So in addition to that, we've got our marketing reimbursement. Another great way for us to partner with you. It's not enough, in our opinion, to just have a robust portfolio of marketing solutions and high service, but how can we inject additional capital into your business to help you accomplish your goals? And so, as you can see there, you get an additional $100 for every 100,000 of qualifying index annuity premium, and then $200 for every 100,000 of SPL premium, and then $200 for 10,000 every 10,000 of life target. In addition to that, back office support. What I would say on that, especially since COVID, and I think a lot of you saw with a lot of the carriers, they got bogged down last year. I think it's really put a spotlight on the importance of working with an IMO that has a very strong back office. A strong back office that understands what the end result needs to be and is working diligently each and every day to shorten that cycle time from submission to commission. And so I would encourage you, if you haven't used our back office support, definitely take advantage of that. Technology is a big theme with IAMS and what we offer. One of the ways that we do that is through the IAMS website. Not only can you run quotes on both the annuity and the life insurance side, but you can also do e-applications for both of those. We've got a variety of marketing collateral on there. We also have our sales resource library, which if you haven't had an opportunity to explore that, I would definitely encourage you to do that. We've got over 500 point of sale pieces on there that range from, annuity basics and how does a 401k work to split dollar and premium finance and everything in between. And so all those pieces you can instantly download off of our website. You just need to log into our website, which means you just need to be contracted with us to get access to that. So if you've got questions on how to access that, reach out, talk to a sales director over here. Phone number is 800-255-5055. In addition to that, with the technology theme, we do integrate with Firelight. We also integrate with iPipeline as well. You can see we've got all of your major carriers up here. And so we make it really simple. Instead of having to have logins to all of the carriers that you do business with, you can just simply go to the IM's website and be able to do an e-app immediately. Creative marketing solutions. So I'm going to take a minute here and I'm going to launch our first poll here. So let me go ahead and launch that. Creative really is the key word. We have a very, very knowledgeable team here that cover web design, social media, content creation, video. I mean, really anything that you want to try and accomplish, whether it's something as simple as a business card to slide presentations, video editing, custom social media campaigns. And so one thing that we have seen over the last few years is that consumers more and more are looking at somebody's brand. They are looking up advisors. They are trying to do research on them. Many of the advisors that we see out there, well, at one point in time during the pandemic, would primarily be digital. Now that pendulum swung back a little bit to where I think most advisors out there, while they might prefer to meet with people face to face, certainly they're incorporating digital at some level into their business. And so I think the core thing is our creative team is dedicated to showcasing the best version of you. And they've got a very impressive skill set to be able to do that. And so I would encourage everybody, if you haven't taken advantage of that, you certainly should reach out, talk to your sales director about that. One thing that we're doing a lot of right now are having advisors go through and do a marketing analysis. It's a great time in the year. So if you're not quite sure, maybe you've got some goals in mind for the year, and you know part of how you're going to get there, but not sure what the total answer is, go through and do that process with your sales director. It gives a clear path forward for how to create the success that you're looking for the year. So we'll keep moving on here. IM's Wealth Management. We have seen this just continue to grow. As we continue to go forward, I think a trend that many of you will see and have already seen is the move toward more comprehensive planning. And that's really why we rolled out IM's Wealth Management, is to help advisors who want to add that component to their business because they feel like it gives them a more complete practice, to be able to offer the same service level that you get with IM's, but all the resources and tools that you need to be successful. And so I would encourage you, if you've got questions on that, reach out, talk to Duncan over there. He can do a very effective job of talking through, what that value proposition is and how they can make a big impact in your business. In addition to that, we are in a new year, so we're getting ready to launch our next series of Life and Annuity Academies. For those of you that haven't had an opportunity to attend one of these, great opportunity. We go through not just sales concepts and ideas, we bring in top producers, we talk about a variety of marketing programs and prospecting programs. Typically, we'll partner that with education from a top carrier in the industry, but it's just a great opportunity to spend some time working on your business. When you're out in the field, you're working in the business, you're dealing with prospects, clients, carriers, IMOs. And so I think it's important when you talk about growth and accomplishing what you want in this business and accomplishing your goals, you've got to have some time where you work on your business. And these are really a great opportunity to do that. We do have our first date coming up in April for our first event of the year. We're going to start doing some marketing around that here, really actually in the next week or so. And so I would encourage you to be on the lookout for that. If you've got questions about it and want to get on the list to get registered, reach out, talk to one of the sales directors over here. The number is 800-255-5055, and they can chat with you about that. In addition to that, we do currently have qualification running for our Seaside Sanctuary incentive trip. Great opportunity to get out on the beach, play golf. I mean, a ton of stuff to do there. This business always has been, always will be a relationship business, and we know that all of you are out there working hard. And so, that's why we try to put together amazing events like this, where it's a good opportunity to not only get together with your IMS family, but also your peers as well. And so in any case, if you've got questions on where you stand on that, reach out, talk to a sales director, and they can chat with you about that. Lastly, follow and like us on Facebook and LinkedIn. We have content going out on a daily basis, whether it's rate changes, upcoming training webinars, new sales packages, a variety of different things. And so it's a great way to get a constant flow of that information that can help impact your business. So today, let me go ahead and get this switched over here. So today we've got an important topic, as I mentioned to you at the beginning of the call. Legislative risk is, a growing factor when you talk about people's retirement. People are going to be retired for 10, 20, 30 years. And so how taxes impact somebody during retirement, as well as from a wealth transfer standpoint, is a critically important conversation. I think it's going to continue to grow. And so the use of tax advantage assets can be a very effective accent to an individual's portfolio. So with me today, I've got Doug Murphy with Baltimore Life, and he's going to be going through a number of different concepts, as well as the portfolio products they have and how you can incorporate that into your practice to not only provide more robust solutions for your clients, and at the same time, drive more revenue for yourself. So Doug, appreciate you taking some time to be on the call with us today.
Thank you, Curtis. I hope you can see my screen. I assume that you can.
I can, yep.
Visibly, you can. All right, thank you. Thank you very much. And thank you everyone for taking the time out of your day as well to join us. I really appreciate IMS, Curtis especially, and Steve as well too, for all the good people at IMS to allow me to take time to present our products and how they might fit in your market today. It's always good as I go through that, and I've heard Curtis go through these things a few times. It's always amazing. I get to do business with a lot of different marketing organizations, IMOs around the country, and the value that IMS provides to you guys is just phenomenal. And I hope you guys recognize that. It's above and beyond any other IMO that I'm aware of, and it's a tremendous opportunity and a tremendous asset and things that they make available to you. So I couldn't be more proud to represent and to work with the IMS group. It's we're a small enough company. I don't have any regionals below me, so I have all the relationships with the IMOs and the IMO principals. So we don't have a lot of IMOs that we work with, but the ones that we do, we think we have a really good partnership with. And IMS has always been one of those that's qualified for our incentive period. It's been one of our top marketing organizations throughout the years, and we really appreciate that opportunity. With that said, my name is Doug Murphy. If I didn't get a chance to introduce myself, I am Vice President of National Accounts. I work with all the independent sales nationwide. We're going to be talking today about asset transfer for the middle market. Now, this is not asset transfer for wealth transfer for high net worth individuals or anything like that. This is truly for the middle market. We're going to be talking about how to move assets, how to move money into life insurance and do it tax efficiently. But the main thing I want to point out to you is that I'm not trying to take business away from it. I realize that vast majority of your primary line of business is the annuity market and helping clients grow their assets. We're here to help you grow your business. And there's going to be times where you're going to run across clients out there that have funds set aside that they're not going to utilize to live off of. And they're just going to have them out there for different types of purposes. And we're trying to help you find ways of repositioning those assets and make them appeal more to your client, be more beneficial to your client. So we want to help you grow your business, not just help you move it from one pocket to the next. If our products, showing our products help you sell more annuity business, we're fine with that, because if you keep using us as an opportunity to highlight, give us an option, maybe instead of an annuity, you're going to look at a single premium or generation legacy product, and it helps you sell annuity. If you're doing that, eventually you're going to sell one of our products, and all we're doing there is helping you grow your business, and eventually it's going to help us as well too. So move from that. What's important to the client? I'm going to talk in general here. I don't know the level of understanding of the agent on the call, so we're going to go through what's important to your client in our market is living comfortably in retirement. It's not living wealthy. It's not having wealth and means out there. They just want to live comfortably. They want to maintain good health. They want happiness and welfare for their children and grandchildren. They want to leave some assets to their heirs if they can, but they need guidance from an agent. This is not somebody that's going to do this typically through planners of something. They're not going to pay people to do that. This is, as I said, simplified issue. It's for the middle income market. They want that client wants to be able to have somebody that understands their needs, help them arrive at a solution. In the last dot point there, I said client should understand the solution within 5 minutes. And there's nothing magical about that 5 minutes. it's really that what I'm trying to point out there is the client, it's got to be a simple solution for the client that the client truly understands and they understand the concept. You know, as I always think about, and whether you have clients out there that's written it down on paper, they've got it in their mind, someplace someplace out there, if they're at retirement, if they've already retired or at close to retirement age, they've kind of got the retirement process broken down into what I would call three different classes. And I use the visual here of the kind of the mason jar. What is a retirement fund? What money do I need to live off of? Contingency funds, this is what I call what if money. What if I need money for a major roof repair? What if I need to have a car repair? What if I have some medical emergency that I need, or maybe a long-term care type need that I need some funds for? I don't want my kids to have to take care of me. That contingency fund, what if money. You know, obviously the last one is a legacy fund, is money they want to leave behind to their heirs or kids or church charity, whatever it may be. Now I recognize that some of this can be done through trust, but most middle market clients don't want to undergo that effort, and they don't want to give up any control of their assets. So let's talk about those three buckets, the retirement fund first. When I talk about retirement funds, I expect it to include Social Security benefits, pension plans, which in this case, I'm talking about defined benefit pension plans. For those of you old enough, and I'm one of those that's old enough to know and have been a part of a defined benefit pension plan in the past where your employer was responsible for providing the pension and making sure that the assets were there to cover that. And then also the third line of that is the distributions from 401ks, 403bs, IRAs, et cetera. So those are the types of things that when I'm talking about retirement funds, that's what I'm including. Now, according to a 2017 American College study, and this is the most recent one I can find that relates directly to this. And American College is an organization that provides a lot of training for the insurance industry. It's one that provides the CLU, the CHFC, the CFP designations. But according to them, a 2017 study, people between 65 and 70 years of age, 75% of that group had a defined benefit pension plan. Now, that's going to be important as we talk about where we're headed with this market. So keep that in mind. 75% of the people right now between the ages of 65 and 70 are in 2017. I don't think that's changed much. Had a defined benefit pension plan. Now, baby boomers entering retirement. Retiring baby boomers, these are people that are in the verge of retiring right now, have a median savings of $147,000 in all household retirement accounts. Now, that doesn't sound like a lot, especially when we're talking about how do we transfer that over, and people may not need that to live off of. But when you think about that, from 2012, that's up. In 2012, it was 99,000, so it had gone up significantly, but it's still not a lot when you think about, you know, what you got to retire off of and all your household saved retirement accounts. 22% of those baby boom workers, people that were still working, had not retired yet, had less than $55,000 saved. So that makes it sound even worse. But when you think about that, only 51% of that group, 51% of that 22%, are very concerned about outliving their savings in retirement. And you think, well, how could that be? How could they have that minimal amount saved and not be worried about outliving their savings in retirement? And I take you back to that previous slide where I talked about the defined benefit pension plan. A lot of these retirees of this age have more money and have a bigger retirement in their defined benefit pension than they do in their 401ks or IRAs and that kind of thing. So a lot of these people, my parents are a good example of that. They had a 401k in the last few years of their work history, but most of their work history was in a defined benefit pension plan. So they live off of their Social Security and their defined benefit pension plan. They keep that, what was a 401k at the time, now they moved that to an IRA, obviously, but they have that money set aside kind of as their what if. They don't plan to live off of it. They live, this group of this age group, typically, if they're going to go on vacation, they pay for that vacation up front. They're not putting a lot of stuff on credit. They like to pay for things before they go out and extend a lot of credit to do those kind of things, unless they're major types of costs, such as a house or a new car or something like that. But you got to put yourself in the mindset of the senior at that age and how they may differ from maybe your demographic and your age group. But a lot of these people are living off of their Social Security and their defined benefit pension plan. And they've left that IRA out there now just to kind of sit there and need it. If they need it, they can get it to use. But if they don't need it, then they're going to pass it on to their heirs. So that's why I think that's where this product comes in, the products we're going to talk about today. Contingency funds. This is assets your client doesn't expect to use to live off of. So if they do expect to live off these funds, obviously our products are not the best place to put them. You've got some other good products there and some annuities. That's probably a better place for that if they expect to need those products to live off, or those funds to live off of in the future. These are funds set aside for unexpected financial crisis or perhaps a medical need. Maybe it's for underperforming retirement funds, or maybe they're worried about outliving their retirement funds. Now, life insurance can provide an opportunity that with the cash value in life insurance to do that. But really what we're trying to do right now is utilizing life insurance and move some of those assets, especially qualified funds, into life insurance and do it tax efficiently. Now, we're not going to put up a slide here for legacy funds, because obviously that involves that just entails moving that money and getting it into life insurance and passing on as much money as we possibly can and doing it tax free, and then utilizing the money that may be in a taxable situation now in the IRAs, the 401ks, 403bs, and that kind of thing, and getting that money out of those taxable assets and moving it into life insurance and doing that tax efficiently. We have two products that we're going to talk about. And I don't like to delve too much into the product. My thought is if you're interested in our products enough, you can go out, if you're a contracted agent, you can go out and get this stuff right off the secure website. If not, the good people at IAMS can provide this information to you. But I always use this screen here. This is a one-pager that I think is available out on our secure website that you can get, kind of give you a good overview, a comparison of the two products. The first product is really our generic single premium whole life. It's often a whole life chassis product. It's not a UL chassis product. And then our second product is a generation legacy. We're going to spend more time today talking about the generation legacy because I think it appeals more to your market, the annuity client that's out there, where you know that you realize where the funds are at, and what we're trying to do is to move some of those funds out of taxable assets and move it over into life insurance. But let's deal with these individually. So they say, which one should I use? If I've got a client out there that's 70 years of age, it's got $50,000. Which one of these products should I use? I always think the best idea of which product to use is where the source of the premiums come from. If it's after-tax cash vehicles such as CDs, money markets, or 1035 exchanges out of other life insurance, if the money's already been taxed, then that money should probably be best suited to going into our single premium whole life. It's really just a lump sum of money, makes one premium payment, buys a tax-free death benefit, no additional premiums paid on it. Cash value will go up from there, and it's a fairly generic type product. But if the funds are coming from annuities or qualified funds, non-qualified annuities, then generation legacy is probably going to be the best solution for that particular client. There's going to be a number of different things down through here that differentiate these products, and every time you see a difference, there's always a reason for it. But I'll kind of highlight some of the differences. The issue ages for the single premium whole life goes from 50 to 85. Our generation legacy goes from 60 to 80. Now, we don't start until 60 because one of the things there, you're using some qualified funds in that typically. So we don't feel like somebody before the age of 60 can answer correctly or answer with a good affirmative that whether or not they'll need those funds to live off of when they retire. And then after the age of 80, the product really doesn't work from a mortality standpoint. The way that the product's structured, it would exceed the mortality table. So we have to cut that off at age 80. So, from time to time, we can make some exceptions from how much premium we can take. But we can't violate the reinsurance treaties and things like that on the ages and those kind of things. So underwriting classes, single premium whole life actually has two underwriting classes. Level 1, which is standard underwriting to table 4. And then level 2, which takes a higher risk type client, tables 5 through 8, and that does take quite a number of impairments. Generation legacy just has the standard through table 4. Most of these products bring point of sale underwriting to the table. Having developed this product and having spent a lot of time as an agent and in the field, one of the things I didn't want to do when we developed it was to have you go out, take an application on the client, come in, submit it to us, and then find out a week or 2 weeks later that the client didn't qualify medically for the product. When you're in the client's house, and right now we still have a paper application process, we're working on an application, but once you completed the paper application on the client, you can pick up the phone, call our underwriting call center. It's an in-house underwriting call center. They're going to get permission from the client to do do a background MIB check, and a prescription drug check, and a LexisNexis check. And they're going to re-ask the health questions on the app. Once that's done, which takes about 8 to 9 minutes at the longest, once that's done, we're going to be able to give you a decision over the phone. Now that 90% point of sale decision right there, it's actually a little over 92% currently. And we're going to be able to do that same underwriting right on the phone. So you know before you leave that client's house whether or not that client's qualified medically or not. Once that call's done, they'll provide you with an application number. You can write that at the top of the paper application. When it comes in, there's no additional medical underwriting that's done on that application. It speeds that process up about 2 weeks over an application that may come in without that point of sale type of decision. So we think that's a great asset to you. If for some reason we don't take the client based off the medical qualifications, you're still in the client's house. They're still probably in a buying mood, and you can pivot to a different carrier or a different type of product. Both of them have a minimum premium of $5,000. The next 3 buckets there, the partial withdrawals, the loans, accelerated death benefit, I'm going to just highlight them together. This is kind of meeting that, what I call that contingency fund, that what if money. What if I need money for certain types of things? Well, you've got partial withdrawal options, you've got loan options that you can access the cash value of the products, and then you have both of these products have accelerated death benefits. They do vary, and there's reasons for that. If I get a chance later at the end, I can come back and tell you what that is. But it's the way the product's structured with the generation legacy that makes it seem like it doesn't have as good of an accelerated death benefit rider, but it actually does. But they do both have accelerated death benefit riders there for terminal illness, nursing home, extended care, home health care, and adult daycare. So it provides money out there, and that's based off of, we're going to accelerate the death benefit. So if they gave us $50,000 in premium and death benefit 70, let's say, based on their age, we're going to accelerate the death benefit we're going to accelerate based off the death benefit, not the premium they paid us. So that it provides more money to have available for those types of things. The maximum base amount for single premium whole life for ages 50 to 80, we're going to go up to what we call a net amount at risk of $250,000. So here, net amount at risk to us on this product says if you gave us $100,000 for somebody that's young, let's say, it's not going to buy more than $350,000 of death benefit. We'll only go of $250,000 above the amount of premium you gave us. Typically, that's not going to be a big deal unless you've got a young client that gives us a significant amount of premium, let's say $500,000. We wouldn't go above, we wouldn't take any more premium that would allow us to go above the $250,000 above the amount of premium you paid us. So if you're 81 to 85, level 1, it's only going to be $150,000, and then level 2, you can see it drops down a little bit, but the same concept with net amount at risk holds true there. For the generation legacy, and this kind of gets into the concept with generation legacy. When you sell a generation legacy, you're going to have one application, but you're going to deliver 2 products. You're going to deliver a SPIA, single premium immediate annuity, and you're also going to deliver a 10-pay whole life policy or a 7-pay whole life policy based on that client's age. If the client is ages 60 to 74, it's going to be a 10-pay policy. If their age is 75 to 80, it's a 7-pay policy. And again, that's based off of the client's age, and that goes back to we can't exceed the mortality, the expected mortality, the commissioner's mortality tables for the client. So to stay within those guidelines, we have to limit that to a 7-pay product. And on the next slide, I'll show you how that concept works. The death benefit for the single premium whole life is just the face amount of the single premium whole life. So again, if you gave us $50,000 and the death benefit's 70, the death benefit's at $70,000. On the generation legacy, it's a combination of the face amount of the whole life policy and whatever the remaining payments are from that SPIA. So let's go to show you that concept. So we're done really talking about the single premium whole life. If you've got after-tax money, if a client's got after-tax money, CD money, and I'll give you some examples of where you can find that money later. But if you've got after-tax money, the single premium whole life would be the best place for that. Let's talk now about generation legacy in particular. This is a client that's I think is fairly indicative of our client. I think it's probably fairly indicative of your client. I'm not trying to put any pie in the sky type of stuff out there. This is a female age 70. She's non-tobacco. She's got a $50,000 non-qualified annuity. with a cost basis of 40. Most of the cost basis there is what she paid into it some time ago. It's now got a $10,000 a gain for a total of 50. So she says, that's your client. She says, hey, I don't need that money to live off of. I've just kind of got it out there as what if money, but I want to leave it to my 2 grandkids in the event of my death. So she's got that there. So you say, okay, well, if you can talk to her about an annuity, but you can say, what about this concept here, ma'am? Let's say that you take that $50,000, you leave the full 50 intact. You could take it and cash it in. You're going to pay tax on that $10,000 in addition to your other income that you might have. But let's try to minimize the amount of tax this client pays. So let's take in 1035 her $50,000 annuity, the full amount, because we want to buy the maximum amount of insurance that we possibly can to pass on tax free. So we're going to take in 1035 her non-qualified annuity, and we're going to move it 1035 exchange it into our SPIA. Now, all of you know that we can't 1035 exchange annuities into life insurance, but you can do it in reverse. But here we're 1035 exchanges from annuity into annuity. So that's the reason we have the SPIA concept. So you can see there in year 1, our single premium shows $50,000. So what we've done there is 1035 exchange her unqualified annuity, and now we have it into our SPIA. At the same time, we've issued, because of her age, we've issued a 10-pay whole life policy. Every year for the next 10 years, we're going to take a one-time pay, an annual payment out of $5,570. We're going to make that payment to pay the annual premium on the whole life policy, which you see to the far right-hand side there is $78,451. That's the tax-free death benefit she's passing on in that event. And that $5,570 is what's paying that annual premium for the next 10 years. Now, how's that benefited the client? Well, one, instead of paying tax on that $10,000 up front, she's going to have excluded based on the exclusion ratio there. And you can see the exclusion ratio. Our software will calculate for you. Based on the exclusion ratio of the 40,000 of cost basis, her exclusion ratio there is 71.8%. So 71.8% of her premium every year is going to be excluded from any income tax. So out of that $5,570, she would have almost $4,000, $3,999 and change excluded from her income tax. She would get a 1099 every year for 10 years. So the 10th year is a little less, but let's say $1,570 every year for the next 10 years. Would you rather pay tax on that $1,570 every year in addition to her other income? Maybe in some cases, based on her other income being low, she may not pay any tax on that at all. But in most cases, that's never going to put her into a higher tax bracket. And it's going to minimize her tax and spread that tax liability out over 10 years as opposed to paying it all up front. She gets to maximize the amount of death benefit because she's using the full $50,000. But as good a benefit to that is that what you see there in that SPIA benefit is also payable at death. So let's say that client died in year 3. The beneficiary would get $78,451 tax-free, but they would also have an opportunity to continue to get the $5,570 paid to them every year and pay tax on that. That portion would be taxable to them in whatever way it was taxable to them. Or they could commute that lump sum for that SPIA benefit you see there payable at death. So in year 3, they could commute that and get $33,850. That would be taxable in addition to the $78,451. So as we're liquidating that SPIA, you can see that SPIA death benefit gets less and less every year, but that's because there's less and less left in that SPIA to pay out. So at the end of that 10-year period, the client would have a fully paid up $78,451 death benefit policy. They would have moved the money tax officially over out of the SPIA and minimized the tax. And the cash value based on this client's age, somewhere around the 7th or 8th year, 9th year, her cash value would have exceeded the $50,000 that she had in there as well too. So, it's going to come. This is going to come with all of the accelerated death benefit riders, all the loan availability, partial withdrawals, and that kind of thing. Let's use the same client and say, okay, she's age 70, non-tobacco. Instead of a $50,000 non-qualified annuity, let's say this is a $50,000 IRA. So there's no cost basis. The exclusion ratio would be 0. So in that same concept, we're going to 1035 exchange her IRA into our SPIA. So it's a tax-free exchange. So you still see that $50,000 column there. The SPIA payout of $5,570 is exactly the same. The whole life death benefit of 78,451 is exactly the same. The speed death benefit's the same. The only thing that changed there is the excluded amount. If it's an IRA, obviously there's nothing excluded. She would get a 1099 every year for estimated taxable income of $5,570. So the idea there is, would she rather pay tax on 50 up front and use what's left to buy life insurance, or would she rather pay tax on the $5,570 every year in addition to her other income, and try to minimize that tax and spread it out over a 10-year period? And we think that concept works best in most middle income clients. And again, this is simplified underwriting. This is not where a client's got to go through and qualify. And you can say, well, I could take one company's SPIA and I could put that over with somebody else's indexed UL, and I could pay this and I could do that. And I realize that you can do that. But in a lot of cases, you're going to have to, for lack of a better term, stand on one leg and make sure that SPIA issues at the same time as a life policy. The life policy gets issued because most of those times the life policies are fully underwritten types of policies. And it's hard to get one company to coordinate the payment to another company without the client getting the funds and then turn around having to make the payment. We simplify that process for you, makes it very convenient, and tying it all into one process. So hopefully that illustration there helps you to better understand the concept behind the generation legacy. Now, here's an option that we added during COVID. We think it's a great sales opportunity for you. And again, if I didn't say this earlier, one of the things I hope, to think about the clients that you're seeing this week, you're going to see next week, or clients that you may have already seen that this is an idea to go back on it. Maybe clients that you worked with that really had no other options for you, but this was something they were looking for. But this is just a sales idea page that I've got to take out. But let's say you've got a client that you've been to in the past that has funds set aside that they're not going to use to live off of, but they're in really bad health. They don't qualify for life insurance, could never qualify for life insurance. But they're married. In this case, right now, it has to be a spouse option because the way we figure that spouses are typically going to file taxes together, and this option works best with that type of concept. So we call it the spouse option. And all you're really going to do is on that generation legacy application, the uninsured client, the uninsured annuitant would be the annuitant. He or she, the uninsured person, would be the annuitant. And the person that's healthy, the healthier spouse, would be the applicant on the life portion. As long as they're spouses, they can qualify for that. They can qualify for this spouse option on that. So you could take the annuity from the uninsurable spouse, have it use the 10-year payout or the 7-year payout to fund the death benefit on the insurable spouse. So that's all that sales option is trying to do. So as you think about all the clients that you may have out there that may not qualify medically, but have some funds set aside in their name that they're trying to move tax efficiently over to their heirs, this may be a great way of accomplishing that for a combination for husband and wife type situation. Now, again, I want to go back to the more than 90% point of sale decision. Right now, it's a little above 92%. We're going to give an approval rate right over the phone. Our approval rates are very high in comparison to what the rest of the industry is doing. And again, we don't want you leaving that client's house and not knowing what the underwriting decision is. So that's our point in being able to do that whenever you do that. Let's say you take a call on a weekend or after hours when we're not open. You can take the application, you can come back in the office, get the client on the phone during normal call center hours, and get a three-way call, and we can do that same underwriting call right over the phone after hours. Where do you find these clients? And again, I don't want to. A lot of these are ideas that we've gotten from other people, and hopefully these are things that are going to click in your mind. And again, just make notes of people that you might want to talk to about, or these are things that just get in the habit of doing. Whether you're already doing these or not, but what we're doing is, especially the generation legacy, we're looking for annuities not needed for daily living. Again, if they're needed for daily living, you've got better options for that in the annuities that you're marketing and selling, providing to clients out there. Get in the habit of asking clients about leave behind money. Now, you know where I'm headed with that, but if you ask a client, Curtis, do you have any leave behind money? Curtis is probably going to say, well, what do you mean? And that gives you an opportunity to have a conversation to say, well, Curtis, if you've got any money at all set aside, it's either live on money or leave behind money. Live on money is money you're going to need to live off of. Leave behind money is money you're going to leave behind to your heirs, church or charity, whatever that may be. Have get an opportunity to look for older paid up policies. You know, my grandfather died long before I was at Baltimore Life to developing single premium products. But you know, one of the things, a lot of these older people still have their old policies in shoe boxes, and a lot of these older policies may be $1,500 face amount policy that's got $1,200 of cash value in it, or a $250 face amount policy when they were really young that may have $500. All told, you may have, you know, my grandfather had 17 policies and had all paid up. It had about $14,000 of cash value when he passed away. Now, if he had been in good health, you could have taken that $14,000 and based off the current mortality table, probably bought a lot more than $17,000 of death benefit. But unfortunately, he was in bad health and couldn't qualify for that. But you know, always want to look for other policies, an old policy that your client may have a bunch of cash value out there in a lot of paid up policies. I started in the insurance business August 27th, 1984. Back then, I was one of the youngest guys in the office, and now I'm one of the oldest. But we sold a lot of Universal Life in the mid 80s. That's when Universal Life came out. We were selling Universal Life, not necessarily primarily for the death benefit, but for the increase in cash value. The interest rates back then were 12, 13, in some company cases, 14% interest rates that you were being able to illustrate those things off of. Obviously, there were some tax law changes in the late 80s. Interest rate environment changed also. But a lot of those Universal Lives were bought and funded, putting money into it with the idea that the interest rates were going to stay up. And what you saw was cash values go really high in the 80s and 90s, and then or even into the 2000s. But get in the habit, whether you work with Universal Life or not, get in the habit of asking your clients if they have Universal Life policies. And it's just as simple as asking that. If they do have one, they're probably going to recognize that they do. They get an annual statement every year. Most of the annual statement looks pretty similar. It comes with a one-page cover letter thanking them for their business, and then there's a second page that kind of gives them a month by month starting month with what the account value was, and then it shows what deductions were taken out for insurance and things of that nature and how much interest was applied to it. And then on the right-hand side, it shows you what account value or cash value was at the end of that month. And it does that every month for that 12-month period. And good idea is to see what the year started, the last year started, and what it ended the year at, most recent year at. If that cash value is going down and going down significantly, it can give you an idea how much longer that Universal Life is going to stay in force. If that money's dropping, let's say you got a client that's got $50,000 of cash value out there in it, but it's dropping $5,000 a year, thereabouts. You can say somewhere between the next 5 and 6 years, that policy is probably going to run out of cash value. It means the client's either going to have to increase their premium drastically, or they're going to lose all of their insurance coverage if they don't do that. Now, most of these clients have already investigated to see what it's going to take what kind of premium it's going to take to get that policy back to where the cash value starts to go back up. And in a lot of cases, if you work with these types of clients, it's a fairly significant amount of premium. So let's say you get a client that's paying $300 or $400 a month, and they've got $40,000 of cash value out there. Not only can you move that cash value over into our single premium whole life, it's going to buy a death benefit. It's not going to be nearly as high as probably the UL was, but the cash value is going to stop going down. They're going to have a guaranteed death benefit the rest of their life. But you're also going to save them that money that they were paying every month in premium for perhaps another product that you can put that into that will be more beneficial to them. Burial account. Obviously, most of you probably don't work in the final expense market. And this is not necessarily a final expense idea, but my mom and dad, when I developed this product, my dad had a $10,000 CD and my mom had a $10,000 CD, and they were both designed to have money available for my brother and I to pay their final expenses. And thank goodness they're both still alive, but in the event of their death, that we would have that fund set aside. I was able to take $6,000 of my mom's $10,000 CD, bought a $10,000 paid up policy, single premium whole life policy. I took about $7,000 of my dad's, bought a $10,000 single premium whole life policy. Together, I saved them about $7,000 out of all their funds, and then provided them with the same tax-free death benefit to accomplish the same thing. So look for people out there. A lot of these seniors, again, they want to prepay things. They want to have things out there that they got money set aside so their heirs don't have to pay for those things and think about that. So look for those opportunities as well too. Accelerated death benefit rider. I put that out there because some of you may be talking to clients and working in the long-term care market. Our accelerated death benefit rider is not long-term care. It's an acceleration of the death benefit. So, but one of the things I think is a good market there is that sometimes you talk to a client about long-term care and knows that market it and sell it and work with it, knows how expensive it can be. Clients, that's one of the prohibitive things about clients buying long-term care insurance is the cost of it. But you've also talked to them about life insurance, and you get that client that says, "Well, I know I need the life insurance, but I'd like the, I like the idea of the long-term care." And typically, a client that's sitting there on the fence never gets off that fence. They never buy the long-term care, they never buy the life insurance. They just kind of sit there. The acceleration of the death benefit rider does provide funds, makes them available for them to utilize in the event they have a long-term care type of need. So it helps get them off of that fence and provide benefit both ways. In some cases, not often, but we can utilize these products to reduce 1099 income and exposure to income tax on Social Security. And then in the idea for business owners there too, there's several opportunities to utilize that in a business environment to reduce tax on corporate retained earnings, to finance your employer's obligation under a non-qualified deferred comp plan, or a vehicle for after-tax employer contributions and that kind of thing. Not a big market for that out there, but if you work in the business market, business owners, you might be able to find ways that these products fit and work in that market as well too. Last thing, and this is an old slide. I've got a slide, and I didn't get a chance to get into this presentation. We just put together the slide this morning. But this is our leaders conference that we're going to in March of this year, based off last year's production. I put this out there as kind of a placeholder to say next year, based off of January 1st of this year's production through December 31st. If you write only these products, it'd be $750,000 in total premium. The single premium on both of these products combined. If you did that, you and a guest would qualify to go to us. We're going to be staying at the Hyatt Zilara. It's an all-inclusive in Cap Cana in the Dominican Republic. But that slide will be what I'll be adding later today. I just didn't get a chance to get in here for this presentation, but I put it out here as a placeholder. This year we're going to the Lowe's Ventana Canyon Resort in Tucson. We typically go out of the country. When I put this together a couple of years ago, it was right in the middle of COVID, and we didn't know if people were going to be able to travel out of the country or not. So it is a domestic location, but again, we'd like to go out of the country. We'd like to utilize all-inclusives and that kind of thing. And we have had qualifiers from IMES in the past, and we'd love to host you and a guest in the Dominican Republic in 2024. I would also like to utilize this screen to say that, as a company, we have consumers that are our clients, and we have a client service center that clients can call in and get beneficiary change forms, all kinds of things like that. But I look at you guys, you and the good folks at IMES as my client. And that means that we want to make sure that we have a service center set up just solely for agents to call in. This is not for clients. It's solely for agents. So that number there is 877-533-2468. One of the most frustrating things sometimes is to call in to get, passed around between commissions. You got a commission question, you got a contracting question, you got an underwriting question, and you got to make different phone calls and be on hold or leave messages. This call center is designed to answer your questions. If they can't answer your question, it's designed to make sure they can facilitate that phone call for you to where you're not being passed around to a number of different folks and being put on hold and put on voicemail and that kind of thing. So I utilize that call center whenever you have questions. Obviously your first point of contact is reaching out to the marketing department there at IMES, and I don't want to supersede what they do, but for some reason after hours or something, you can reach back out to center and they can help you as well too. So Curtis, that's the end of my presentation. I'll be glad to take any questions. I haven't seen anything in the chat or any questions that come up. I'll be glad to try to answer those or get back to you with answers to them if at all possible.
Sure. Well, and so to get started, I got a couple more polls I want to get launched here. So I'm going to launch the first one. I think that's a key thing is you look at where people have retirement savings, and a significant portion of that is in qualified accounts. And so I really like that Gen Leg product where it has the ability to, gradually convert that over. And I think that's a key selling point. So I'm getting a poll launched here for those individuals that maybe want some more information from the marketers on that. Doug, from your perspective, looking at this, like, do you see a split in the volume of business from the like the traditional SP, SPWL versus the Gen Leg, or what do you guys see from your perspective?
Curtis, most years we see a fairly even split. Like last year. Last year was a little odd because the fixed annuity market, the MIGA market, was so strong that it probably took some business away from our generation legacy, and we had more money than going, and it's going into the SPWL than the generation legacy. Typically, it's a fairly close. According to what's going on in the annuity market, uh, how hot that is as to where we're getting those funds coming into the generation legacy. But again, I think it's really, this the generation legacy in particular is it's a good second option to go to a client with. You may go to them with some information that maybe you're going to that annuity client that's got some rollover money, and you go to them with an annuity rollover option. Maybe the generation legacy is something that they want, that they've got some funds they want to set aside just to leave behind. And I think it's just making it part of the conversation is all that I'm asking. If you do that, I think you're going to sell some of our product, and hopefully it'll help you sell some more annuity premium as well.
I think so. So as we wrap up here, I'll launch our last poll. For those of you that have been on this, I think what you've seen is that Baltimore Life has a very strong portfolio of products to address a lot of needs, and so I think there's a good opportunity. So I'll launch this last poll. If you'd like to get a contract set up so you can get access to the website, additional marketing cloud, etc., go ahead and fill that out. Doug, I appreciate you taking some time with us today and kind of giving us a deep dive of this. Make sure the advisors are aware of these solutions and the opportunity with them. And for those of you advisors on the call, I appreciate you taking some time with us today to learn a little bit more about this, and also a little bit more about IMES and some of the ways that we work to add value to your business. So Doug, appreciate the time today, as well as everybody else on the call.
Thank you.